This is the fourth lecture on risk and return, and it's called diversification. Our goal is here to understand the concept and meaning of diversification, and then we want to start building portfolios. So I want you to be able to calculate an expected portfolio return for two or more assets, and then I want you to be able to calculate portfolio variance and the standard deviation for a two-asset portfolio. And then sort of at the end, understand where we're headed with this. What are the limits of diversification? Well, diversification is kind of an important concept in finance. It's just the idea that we don't put all our eggs in one basket. When you guys applied for college, you probably had a backup option in case you didn't get into your selected choice. This is the idea of diversification. If you failed in your first college choice, you had a backup plan. Same idea of investing. We invest in multiple assets, so if we lose money on one asset, we're somewhat hedged or covered by the performance of the other assets in our portfolio. Our goal is to limit our downside. And diversification can do that. By investing in multiple assets, we can reduce the overall average risk in our portfolio. Historical numbers sort of prove this out. If you look at the risk or volatility of the S&P 500, remember that's the 500 biggest stocks in our economy, you see a standard deviation of 20.1%. But if you look at the risk of the individual components of the S&P 500, you'll notice that it's quite bigger than the overall average. So in other words, when you put these stocks together, you can reduce the average risk. That's diversification. Here's a simple example. So in case one, we have stock A and B, and we're just putting half our money in each, and there's two states of the world. In state one, things go one way. In state two, there's another result. Here, in this case, in state one, both stocks had the same return, 20%. So I guess in sense, they're both down. In state two, both stocks return 30%. So as you see, they do the same thing each time. So you either get 20% in state one, or you get 30% in state two. Now the average here would just be the average of the two states, so 25%. Notice the second case. In case two, when A gets 20, B gets 30. When A gets 30, B gets 20. So they're not doing the same things. When one's down, the other's up. When one's up, the other's down. Now they still get the same average return of 25%, but notice in state one they make 25%. In state two they make 25%. So there's much less volatility. And we get that because the two stocks don't do the same thing. And that's a key thing to remember. So if you summarize this, when A and B moved together, we didn't really gain any risk reduction. Okay, so in other words, we're going to call this, they're highly correlated in a moment. When A and B moved apart, we say these stocks are negatively correlated. We got rid of the risk. So what we're looking for is assets that aren't exactly alike. So the basics of diversification, when we put two or more securities together, we remove risk. The more these two securities are alike, the less risk we remove. Okay? So for instance, in everyday life, that would be like us picking two tech companies. Okay? The way I would get more diversification would be maybe to pick a technology company like Intel, or maybe a bank, or Coca-Cola. Companies that don't do the same thing. So the more two securities are different, the more risk we can remove. We use something called a correlation coefficient to measure this degree of likeness, or how often the returns move together. So correlation can move between -1 and 1. So if the closer correlation is to 1, the more alike the stock returns are. So in other words, when one stock goes up, its return is higher. In other words, the other stock's return is higher. When one stock's return is down, the other stock's return is down. So in other words, they do the same thing. So you don't really benefit and you can't reduce risk. And when the correlation is closer to -1, that would be like a seesaw. So when one stock's return is up, the other stock's return is down, and vice versa. The point is, you reduce some of your overall risk. So the lower the correlation, the greater the diversification. Let's see this in an example. So suppose I decide to invest in Motorola and TI, Texas Instruments. So we'll call Motorola stock A, and we'll call TI stock B. Let's say these stocks have a correlation of 0.25. So what that means is 25% of the time, Motorola and TI's returns move in the same direction. And they don't have to move the same amount, but they move the same way. So if Motorola's up, TI's up. If Motorola's down, TI's down. Only 25% of the time. This is good. We'll be able to diversify some risk. So suppose we invest $4,000 in Motorola and $6,000 in TI. Well, the first thing we want to figure out is what portion of my money is going into each stock, and we call that the weight. So let's define W mott as the weight in Motorola. So that's simply going to be the dollars invested in Motorola divided by the total dollars invested. So I put $4,000 in Motorola, the problem told me. So the total invested would be the dollars I put in Motorola plus the dollars I put in TI. So it says we put $6,000 in TI, so my total investment is $10,000. Motorola is $4,000 of that investment, so the weight would be 0.4. We could do the same thing for TI. Notice it would be $6,000 divided by the total we invested of $10,000, so 60%. And of course, notice that the weight's added to 1. So in other words, I'm accounting for every dollar that we've invested. So we can calculate the expected portfolio return. It's just another weighted average. We take the weight in an asset times its expected return, and we add them up. And this can work for as many assets as you want. Now in our world, we're going to deal with 2 stock portfolios, just to illustrate the point. So here, 40% in Motorola times the expected return of 12%, plus 60% in TI times its expected return of 15%, gives us an expected portfolio return of 13.8%. Key thing, that doesn't mean that's what we're going to get going forward. That's what we expect. Remember when we talked about the normal distribution last unit? Returns are random variables. So we might have a normal distribution with a mean or average of 13.8%, but our actual return might be bigger, might be smaller. That's what we're going to try to predict. Continuing with this example, let's go back to calling Motorola A and TI stock B. We want to calculate a portfolio return. Now if we look at this, and I have a couple of typos here, so double check this in your book. I apologize. I'll supplement this material. We have the weight squared in Motorola times its standard deviation squared, which is the variance. We do the same thing for stock B. We square its weight, and we multiply by its variance squared. That B right here, which I'll highlight for you, should be a subscript. Oops. The final term is the most important term. We call this our covariance return piece of the equation. And if you look at it, it's covariance because it looks at how A and B's returns move together. That's the critical part of this. The individual risk, at the end of the day, honestly, does not matter that much. What matters is how A and B interact together. And if you look at this, you see that you have 2 times the weight in A times the weight in B times the correlation, then times the individual risk in each stock. The key piece there is the correlation between the returns on A and B. That tells you how often A and B's returns move together. That's what we used a minute ago when we were just describing correlation. If you plug this in, we get variance. Now hit pause and make sure you're good with this calculation. Notice we took the weight squared times the standard deviation squared for each stock individually. Then the third term is 2 times the correlation times the weights times the individual standard deviations. Variance, once again, has little meaning, so we take the square root. And we get a risk of 17.44%. Notice, when we put these stocks together, the combined risk is less than the individual risk of each stock. That's the big thing about diversification. The risk of Motorola is 25. The risk of TI is 20%. The risk of our portfolio is 17.44. By building a portfolio of 2 assets, we've come up through diversification and we've reduced average risk below the individual risk of each asset. Doesn't always work out that way, but this is the power of diversification. And back on the correlation idea here, as you read through this slide, the correlation was 25%. So that meant the other 75% of the time, these stocks are doing their own thing. That's where you get diversification. The part of the time they're not acting alike. Let's bring this back to confidence intervals. If you remember the last lecture, we talked about a 95% confidence interval using the normal distribution, was just the average plus or minus 2 standard deviations. If we work this back to portfolios, the average would be the portfolio return, and we'd say plus or minus 2 standard deviations. So let's plug in our 2 stock portfolio results we got a minute ago. And you see my range ends up being negative 21% all the way up to, that's almost 49%. That's a 60% range, or 70% range. For many investors, that's too wide an outcome. That's what motivates us to buy more and more stocks to tighten that standard deviation and reduce the overall average risk.